This is Dr. T. Varalakshmi discussing you about internal rate of related problems and its solutions as a part of the capital budgeting techniques and as a part of break-even business economics and financial analysis. Under the capital budgeting, net present value is one of the method of discounted cash flow techniques. That is, if the time value of the money is taken into the consideration by the investor, then based on that one, how to calculate the net present value that we have discussed in the previous videos. Now, the internal rate of return means at what rate the organization has to get the profits to get the no loss, no gain point. That means what is the best rate that gives the saddle point or the hurdle point of the investments is going to be calculating with the help of this IRR. That gives whenever the rate at which where the NPV becomes 0, then that rate will be called as the internal rate of return best suitable for the compounded annual rate of the investments. So that's why generally in the NPV value we have taken this NPV is equals to cash inflows at the initial periods plus all the present value of the cash inflows, outflows, that values we have taken into the consideration. Whereas that value, NPV value should be 0, means the best rate to get back that returns is called as the present value. So best thing is if you are investing 10 rupees, if you are investing 10 rupees now and in the future if they are going to be get 15 rupees and if that present value of 15 rupees is also now 10 rupees means the rate at which you have to get that return is might be 10%. That 10% calculation is called as the IRR. Here CFO means cash flows, investments, that is initial investments at the 0-year tier means initial investments, that is outflow, and cash flows at the first year, cash flows at the second year, up to the n years it is going to be taking into the consideration. So whereas if it goes to this side, minus values, that is cash inflows should be equal to the cash outflows. So for this one calculation, the IRR formula is rate 1, that is lower discount rate plus NPV of a first discount rate into the difference between the lowest and highest discount rates divided by NPV differences for the two different discount rates. So which means if for this one NPV negative value will be takes into the consideration, NPV positive value will be takes into the consideration. For example, for a project at 12% returns it is getting losses, whereas at 15% returns are all there it is getting the profits. Then the average between the 12 and 15 will be called as IRR, internal rate of return. That is R1 will be the 12%, whereas the NPV at 12% will be the NPV 1, and 15 to 12 difference is 3 divided by NPV, difference between the NPV at 12% and difference between the NPV at 15% is the formula for the calculation of IRR. So that's why initially for their investments the present values might be 0, that one. So here if the cash out, if they start slowly getting off the profits, that break even point meeting of the cash investments as well as the incomes gaining with that particular project will be called as IRR, internal rate of return. So the given problem 1, Mr. A is considering an investment of 25,000, 2,50,000 in a business, and the cost of the capital for the investment is 13%. From the cash flows, you are expecting an investment of first year 50,000 cash inflow of first year 50,000, second year 1 lakh, third year 2 lakhs rupees. And asking us to calculate IRR for the proposed investments and interpret the answer. Step 1. Select 2 discount rates for the calculation of the NPVs. We can take 10% as the R1 and 20% as the R2 as our discount rates. Why we have to take as a 10 and 20 means So just a huge difference is there, but 10 to 20. So that's why just we are trying to calculate the NPV at 10% and 20%. If that the 10% and 20% both are getting the plus values, below to that one we will try. Let us say at 10% if we get a positive NPV, at 20% if we get a negative NPV, then we will consider these two. But at both the values we are getting a positive, means the next level of the rate of return we will take into the consideration. So that's why at R1, NPV 1, 10% value for the cash flows of this 25,000 cash outflow, that's why it is in brackets, and the cash inflows of 50,000, 1 lakh, 2 lakhs, and that discount factor is 1 rupee here. Here it is 1.09, that is 1 divided by 1 plus 0.1 whole to the power of 1, 1 divided by 1 plus 0.1 whole square. Here that is 1 divided by 1 plus 0.1 whole cube. That is, we know the formula of 1 plus r to the power of n for the calculation of present value of the money. So if we multiply this cash inflows with this present value of the 1 rupee, we will got all these levels. 45,000, 450, 82,600, 1,50,200 and all. So the total of this one, if we less with 2,50,000, NPV value, positive value, we got 28,250 rupees. Same way, we will calculate the NPV at R2 value, that is 20%. 20%. And cash outflow, that is bracket value 1 rupee, and here 0.81 divided by 1 plus 0.2 whole to the power of 1. Here it is 1 divided by 1 plus r, that is 20%, 0.2 whole square. Second year it is 1 divided by 1 plus 0.2 whole cube because of the third year. If we multiply these factors with 50,000, 1 lakh, 2 lakhs of this one, we got the negative value. That's why we'll consider it as the highest rate of the NPV, and lowest rate of the NPV is 10%. If this 20% is also, if it is positive, then we will try it for 30% or 5% more of that one. So like this we will try, keep on tries this positive and negative relationship to get one discount factor where gives the positive NPV, another discount factor where gives the negative NPV, has to calculate. After that one, just applying them in the formula. That is R1, that is lowest factor 10% plus NPV at R1 is 28,250 plus the difference between this one is 10%, and NPV's differentiation between these two, minus into minus it is plus, so that's why the total, and 15.5%. So which means if the organization gets 15.5% of the returns, then for their cash inflows and the outflows, that is equivalent for their cash inflows with the outflows present value. This is the one of the methods to calculate the IRR. And some other methods are also there. So let us have the discussion about them in this problem 2. The management of VGA textile company is considering to replace an old machinery with a new one. And the new machinery will be capable of performing some tasks much faster than the older one. And the installation machinery will be cost 8,475, will reduces the annual labor cost by 1,500. And the useful life of the machinery will be 10 years, will no salvage value. And the minimum required rate of return is 15%. Should VGA textile company purchase the machinery? By using the IRR method, we have to calculate that particular problem. So for this one, this is another method to calculate the IRR. To conclude that whether the proposal should be accepted or not, the internal rate of promised by machine would be found first, and then we'll compare the company's minimum required rate of return. The first step is finding out the internal return, compute a discount factor called internal rate of return factor. So it will be calculates with the internal rate of return factor value formula, net initial investments divided by annual cash inflows. So in our example, the required investment is 8,475, whereas the net cost savings means annual return only, that is 1,500, that is 5.650. This is the IRR factor value, not the IRR rate, it is a factor value. After computing this internal rate of one, the next step is locate this discount factor at the present value of the annuity of 1 rupee in arrears table. So we'll get in every statistical or in BEFA related one statistical or in the internets, everywhere we will get this annuity value for 1 rupees, arrears values and annuity values. We will get that values standard ones, and otherwise we will use this formula of 1 plus r to the power of n value. But for 1 rupee, 2 rupees, 3 rupees calculations, it will be time consumption. So directly we can locate them under the annuity values. In the arrears values, if we take at the 10th year, if we find for that 5.650, it is a 12%, which means the internal rate of return of the project is 12%, and the textile company is expecting 15%. So minimum to minimum 12% they have to get, and that's way the final step is to compare with the minimum rate of required with VGA textile company, that is the 15%. So according to here, the calculated IRR, that is 12%, is less than the minimum rate of required as a 15%. Minimum to minimum 15% they have to get, but they are getting only 12%. So that's why it said that the promised by the proposal is discount rate, that is proposal is not accepted. Proposal is rejected because the promised internal rate of return is not going to be get back with this expected cash inflows of this proposal. So like this, we can calculate the IRR by using this factor. And that too, if we see this one, initial cost of that machinery is 8,475. Life of that project is 10 years. Annual cost savings is 15,000. Salvage value is 0. Then annual cost saving to 10 years is 15,000 into factor value 1 at 12% we have calculated, right? So 1 plus r 0.12 whole to the power of 10. So we won't take a 1. Because the factor value we are taking 1 plus 0.12 whole to the power of 10, if we take it will value will be 5.650, that is 8,475, whereas the initial investment is 8,475. NPV is 0, so which means it is the internal rate of return. But the minimum expected rate for the company is 15%. So that's why they are, this proposal is going to be rejected. So like this, by using the internal rate of factor value calculation and locating that value in the annuity table, arrears values we have to see. At the life of that one is 10 years, means at the 10 years, this 5.65 value will be exactly comes under 12%. If it won't comes, we'll take these two values into the consideration. In between that values will be takes into the consideration. Points if we have to calculate. It's like this, two methods can be used for the calculation of the IRR. So the direct method or the indirect method also we can use this one. So the advantages of this IRR is expressed in terms of the percentage rate of required and exactly helps in finding out that what rate the organization has to get the benefits. So that is about the calculation of the internal rate of return for the proposal. But when compared to the NPV and IRR, NPV is the best method to calculate, but whereas exact cash inflows returns can be located with the help of this NPV than the IRR. Anyhow, IRR is an extension of the NPV only, and it gives the rate of return or the discount rate of return which is suitable for the cash inflows. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.